Let's have a look at the next metric, accounting rate of return. Strictly speaking, this is very simple and easy to understand metric, but there are some complications related to depreciation and some other bits. Generally, accounting rate of return simply represents return on your investment, and it's very easy to understand. It simply divides profit by your investment. So if you've invested £100, you've generated £15 profit, your accounting rate of return is 15%. You always take profit and divide it by the investment size. So it's just a normal standard accounting ratio. There are very different names for it, different versions of this formula: rate of return on capital employed, return on investment, and so on. You always take some measure of profit and divide it by investment. The problem is what measure of profit you use and what type of investment. That is why the formula is not as easy as it might sound. For example, here, average accounting profit before interest and tax, but after depreciation. This is what we should be using. And later in your course of studies, you will learn that you need to pay attention to these bits all the time. As an accountant, you will need to have really good eye to detail. You always need to remember whether tax is included. Is it before or after depreciation? What do you do with interest charges? Are they included or not? Because different metrics, different formulas will require different versions of profit. Profit can also be different, can be gross profit, can be operating profit, can be net profit, can be before or after tax profit. So what specific profit do you use? That's a complication. And here, in this particular module, we are going to use this specific formula. So please make sure that you understand what measure or what variable for profit you are asked to use. First of all, it's an average profit. In other words, you take all cash flows, add them up, and divide them by the number of periods to calculate the average cash flow. That's first. Second, you need to take depreciation into account. In other words, you need to take total cash flows and subtract depreciation. Because you haven't started studying accountancy modules yet, you probably don't even know what depreciation is. Very important concept again in accounting. It shows how the value of an asset declines over its lifetime. So let me just give you a quick example, depreciation example, just to explain this. Let's imagine that you purchase an asset which is worth, initial starting value is £100 for simplicity, year one, when you've purchased it. You use this particular asset for, let's say, 5 years, and the end value is going to be, let's say, £30. It's a scrap value after 5 years. After 5 years. So what is the decline in value? What is the reduction in value? The reduction, the drop in value is £70. This is what you've lost during 5 years. And if you split this reduction in value by 5, if you divide 70 by 5, you will get an annual depreciation. So this is going to be 14. £14 is annual depreciation charge, is annual depreciation. So total depreciation is the reduction in value of an asset over its lifetime, and annual depreciation is the total divided by number of periods. It's not a cost as such, because it's just an accounting entry, because you are not paying £14 every year. What is happening? You are buying an asset initially, you invest £100, and you might be able to resell it after 5 years. You do not incur this expenditure every year. Nevertheless, it will appear in your financial statements, and in your accountancy modules, you will study this all the time. You will need to take this into account all the time. It's a quite specific type of cash flow, which is not actually a cash flow, but it's an accounting entry. It's an entry in your financial statements. And here, to calculate the profit, we are taking this into account. We reduce our average profit by the amount of depreciation. So that's first thing, that's first complication. The second complication is the denominator in the formula, because you can again use different metrics for investment itself, right? That is why you might have to calculate accounting rates of returns in a different way. You can use an average investment or initial investment or the final investment. In my module, in exams, I will always ask you what specific metric I want you to use, whether it should be based on average or initial investment, right? So don't be scared, you will not make a mistake, I will make it clear, but make sure that you pay attention to this. If it's based on the initial investment, it's easy. For example, you've earned £15 on £100 invested. Your accounting rate of return is 15%. But what is average investment? For average investment, you use another formula on the next slide, which takes into account the scrap value. And interestingly, unlike depreciation, you do not remove scrap value, you add it here. So when we calculate depreciation charge previously, what we've done, we took the initial value, subtracted the end value, which gave us the depreciation. If we calculate the average investment for this formula, we do the opposite. We add up the initial balance, our initial investment, plus add scrap value, 30 pounds scrap value, and divide by 2, which is not particularly intuitive. So the average investment for accounting rate of return formula is going to be 130 divided by 2, 65 pounds. Apparently, the result will be totally different depending on whether you use 100 pounds as a denominator or 65 pounds. Please pay attention to this when you will do calculations. So now let's apply these formulas. Let's do this particular case. Let's have a look. We are considering a project which cost £200,000. It generates the following cash flows. These are different cash flows. That is why we'll need to take the average. Machinery can be sold at the end of the project at 20,000. This is the scrap value. That's initial investment for our formula. Now we just gather all data together and plug them into the formula. We need to calculate the accounting rate of return based on average and on initial investment. Let's do the average first. This is the formula which you are using. All the time you take profit and divide it by investment. It's just which profit and which investment. This is the formula for average profit which I've shown you. This is the formula for average investment. Let's plug in our numbers. To calculate the average profit, we take total cash flows. In other words, we add up all of these figures, all of these numbers, 60 plus 20 plus 150 plus 30 plus 10. So these are our total numbers. These are our total cash flows. These are total cash flows. We add them up, which happens to be 270,000. Next, we need to subtract depreciation. What is depreciation? Depreciation is the difference between the initial balance and the end balance. So 200,000 minus 20,000. This is our depreciation. This is the total depreciation, 180. It's a reduction in value of our asset. This is what we have here. This is depreciation, 180,000, right? So these are our numerators data, and we need to divide this by number of periods. Number of periods is number of years. In this case, it's 5 years. That is why we divide this by 5. That's the last bit. Divide by 5. So what do we have here? Total cash flows, 270 minus 180 of depreciation charge divided by 5, which makes it 18,000 pounds. This is our average profit, 18,000 pounds. This is what we've calculated using the first formula for the denominator. Now investment. We can use average investment, which is calculated using the second formula. So let's have a look. Our initial investment was 200,000 and scrap value was 20. So 200,000, scrap value was 20, 220 in total, divided by 2, 110. This is our denominator. You see, 110. This is what we've done. And if we now divide the average accounting profit by this figure, 110, we will get 16.36%. This is the purple figure, based on average investment as a denominator. You might, however, be asked to calculate it based on initial investment, which is probably more intuitive and which is probably most CEOs will be interested in. So this will be more common, divided by initial investment. We've invested 200,000. If we divide our accounting profit of 18 by 200,000, we will get an accounting rate of return of 9%. As you can see here, the figures are so different. 9 and 16% are totally different numbers, right? And your decisions will be apparently based on the rate of profit you expect. And here, the decision-making criteria are also rather simple. The higher, the better. The higher the accounting rate of return, the better it is. You generate higher profit. And if the projects are mutually exclusive, if you can select only one of two projects, obviously you should go for the one which generates higher profit, right? You accept all projects which generate a return higher than your predetermined rate. For example, in this case, if I will say that my target rate is 8% return, this project is suitable, right? The thing is, what if my target rate of return is 10%? Do I accept it or not? It depends on which measure I select, based on average investment or initial investment. And strictly speaking, as an accountant, you can manipulate the opinion of decision-making person by providing totally different figures, because you are not lying. These are all correct figures, all based on calculations. However, you can misguide your management by giving them the data presented in a certain way. This data on accounting rate of return can easily be manipulated, because obviously if you tell the manager that the project is only 9%, generating 9%, you're not lying, that's the case, it doesn't look particularly attractive. If you tell them it generates 16% of return, again, you are telling the truth, you're just not giving the full truth, right? You are not just explaining how the data was calculated. That is why you should be very cautious when you read financial statements or financial reports. You always need to pay attention to the accounting policy, which data is being reported, because it's very, very easy to misinterpret this information if you don't pay attention to how they've been calculated. Just be aware of this. It can be both an advantage of this metric if you want to present a certain project in a very attractive light. For example, you are applying for a loan and you need to provide a business plan to support your ideas. You really desperately need this money. And obviously, in this case, you would report a 16% expected return, not 9%. And again, you are not lying. This is the correct figure. Right? By selecting which figures to report, you can guide the decision-making person or decision-making committee in a certain way. You can manipulate their opinion. So you have enormous power in your hands. As an accountant, you can do quite a lot of things with your data. And this is a very simple example. And similarly with the metrics which I've mentioned here, as I said, accounting rate of return can also be known as return on capital employed or return on investment. Again, they also use totally different figures. Sometimes it will be operating profit, sometimes it will be before tax, sometimes it's after tax, sometimes it will include depreciation, sometimes not. And as an accountant, you will be able to calculate a variety of these figures and report the ones which you need. So be aware of the power in your hands when you use this particular metric. Let's move to the next exercise. Let's do exercise 5. Prepare an investment proposal to your boss. Your company uses a certain target rate, which is 30%, very high, a very high rate. Details are below. You need to calculate and decide or advise whether it should be accepted or not. So cost of equipment is 200,000. This is your initial investment. Residual value is 40,000, which immediately implies that your depreciation is the difference. It's 200 minus 40, which is 160. It's a total depreciation. Because the estimated project's life is 10 years, if you divide 160 by 10, it's going to be 16,000 per year. It's annual depreciation. Average annual operating cash flows before depreciation is 48,000. You need to decide, you need to advise what will happen. So here we use average annual data rather than individual cash flow. So we don't divide by number of periods because they've been given per period already. So our annual depreciation charge is 16,000. This is what I've shown you. It's 16,000. We can see it straight away. And we are also told that the average profit per year is 48,000. It's calculated per year already, which means that average accounting profit per year is the difference between cash flow per year, 48,000, and depreciation charge, 16,000, which is 32,000 pounds. This is accounting profit. And now investment, if we use the average figure, here we add up the initial investment, 200,000, plus the scrap value, 40,000, divide by 2, take the average, which is 120. And now we simply divide one by another. We divide 32,000 by 120, which generates an accounting rate of return of 26%. Obviously, this is below the minimum required, so it's not as attractive, and the chances are this proposal will be rejected. However, please pay attention. If we divide this figure, 32,000 pounds, our annual profit, by the initial investment, which is 200, you will get even worse. So 32 divided by 200, 16% only. So if you base a figure on initial investment, based on initial investment, it's even worse. So if you want your project to be accepted, you would report this figure, 26%. If you want it to be rejected, you can report this number. And as I said, you can manipulate the decision being made, which is both an advantage and disadvantage of this specific metric. Any questions? Yeah, it's up to you what to report. Sometimes managers will pay attention to this. Sometimes they totally rely on you and they depend on you. They depend on your professional advice, and it will be your professional judgment. And there are ethical considerations here involved because you want to be providing the valid information. You don't really want to skew decisions made by the management. You want to ensure that what you are doing will lead to increasing welfare of your shareholders who hired you. So there will be ethical considerations involved in how you treat the data. Next, here we have a choice between different alternative investment projects. So there is a company who wants to purchase or considers buying two types of equipment, two models of equipment, which cost different amount of money. So the first model costs 100,000. Another model is more expensive. It requires an investment of 175,000. And if you purchase this particular type of equipment, it will probably have different productivity and it will generate different types of cash flows. It will also have different disposal values. So these are our numbers. The expected life is 5 years. These are costs and profits. We need to calculate the accounting rate of return and decide or advise which project we should invest in, right? Let's calculate the average profit. To do this, we again take the total cash flows and remove depreciation. So we add up all of these numbers. These are our total cash flow for both projects. And depreciation is calculated as the difference between the initial balance, initial capital cost, 100, and disposal value. So it's 80 for project A and 175 minus 25, 150 for project B, for model B, right? Plug in these figures into our formula. So this is a sum of total cash flows from the table. This is our depreciation. We take the difference and divide by number of years, which is 5, right? And we will be able to work out the profit for this particular model equal to 16,000 pounds. For the second project, we do the same thing. We take our cash flows, remove depreciation, divide by number of periods. By the way, number of periods can be different for different models, for different projects. Different models, different equipment can have different lifetime, but you calculate the average profit in the same way. So you can see here that project B seems to be more profitable. It generates higher profit. This is profit from project B, and this is profit from project A. But it doesn't necessarily mean that project B will generate higher return because it also requires high investment. It's nearly twice the cost. This machine is more productive. It will generate higher output and higher profit, but it requires high investment, initial investment. We need to take this into account. So if we calculate our profitability figures or return figures based on the initial investment, we will get 16% for project A and 14.8% for project B, which implies that in spite of the higher absolute figures, the accounting rate of return for project B or model B is lower. That is why, strictly speaking, a company should select model A because it's more profitable based on this particular criteria, based on its rate of return, unless we want to maximize the absolute value of profit generated by the company. And this particular example shows another disadvantage of this particular metric. It gives you a percentage. 16% seems to be better, but on the other hand, you are only generating 16,000 pounds profit. While with this one, which is slightly lower in percentage terms, you are generating higher absolute figure. So it's not exactly as obvious which project you should select, which means that this particular decision-making criteria is not complete, I would say. You should never base your decisions on one number only. You should consider the project as a whole. You should calculate various metrics and take this into account, right? And again, if you've calculated this based on average investment, the figures would be totally different. That is why never ever allow the numbers to direct you. Have a look at the general picture. You need to have a clear understanding of what is happening here. Okay, let's have a look at the next questions, which are based on net present value. This is very, very super important.